understanding call options in detail. In this lesson, we will understand how a call option on MCX actually works using payoff charts. We will take MCX gold option as an example. Remember that gold on MCX is quoted per 10 grams, but the lot size is 1 kg. So for one lot, we multiply the option payoff by 100. In our example, a trader buys a gold call option with a strike price of Rs 1,40,000 per 10 grams. The option premium is Rs 5,300 per 10 grams. This means the trader pays Rs 5,300 into 100 equal to Rs 5,30,000 as premium for one lot. Now, what does the call buyer want? A call option buyer is bullish.
What does bullish mean?
The buyer wants gold prices to rise above the strike price. Here, the strike price is Rs 1,40,000 per 10 grams. If gold futures expire below or at Rs 1,40,000, the option has no intrinsic value. If gold futures expire above Rs 1,40,000, the option becomes in the money.
So the higher the gold price moves above the strike price, the better it is for the call buyer.
Exactly, Ayush. Please note that in these examples, the futures expiry price means the price of underlying gold futures at the time of gold options expiry. The actual expiry of underlying gold futures happens after the gold options expiry according to the exchange calendar. Payoff formula.
Could you explain payoff formula and its importance?
Sure. The formula for intrinsic value per 10 grams is max of 0 and expiry futures price minus strike price. This means that if expiry futures price minus strike price is greater than 0, then that is the intrinsic value. If expiry futures price minus strike price is less than 0, then the intrinsic value is 0. Intrinsic value cannot be negative. Intrinsic value per lot equal to intrinsic value per 10 grams into 100. Net profit or loss per lot equal to intrinsic value per lot minus premium paid per lot. First, we calculate the intrinsic value per 10 grams. For a call option, intrinsic value is the expiry futures price minus the strike price. Then we multiply that by 100 because one MCX gold lot represents 100 quotation units of 10 grams each. Finally, we subtract the premium paid for one lot. The premium is Rs 5,300 per 10 grams. For one lot, the trader pays Rs 5,300 multiplied by 100, which equals Rs 5,30,000. This is the maximum loss for the call option buyer. So in this example, the maximum loss is Rs 5,30,000 per lot. This happens if the gold futures expire at or below Rs 1,40,000.
So if the gold doesn't rise above the strike price, I lose only the premium I paid, correct?
Yes, that's right. Break-even price.
What exactly does break-even mean?
The break-even price is the price at which the trader neither makes profit nor loss. For a call option, the break-even is strike price plus premium paid. Here, 1,40,000 plus Rs 5,300 equal to Rs 1,45,300 per 10 grams. So the trader starts making profit only if the gold futures expire above Rs 1,45,300 per 10 grams. We have created a table here that shows the net profit or loss per lot at different gold futures prices on expiry date. Payoff table for one lot. Gold futures price on expiry per 10 grams, intrinsic value per 10 grams, gross payoff per lot, premium paid per lot, net profit or loss per lot. explaining the table. Let us now understand the table. We will plot each of the points in a chart as we give examples. If gold futures expire at Rs 1,35,000, the option is out of the money. The call option has zero intrinsic value. So the trader loses the entire premium of Rs 5,30,000 per lot. The same happens at Rs 1,36,000, Rs 1,37,000, Rs 1,38,000, Rs 1,39,000 and Rs 1,40,000. At 1,40,000, the futures price is exactly equal to the strike price. So the intrinsic value is still zero.
So in this case as well, I lose the premium.
Yes, that's right. Now suppose gold futures expire at Rs 1,41,000. The intrinsic value per 10 grams is Rs 1,41,000 minus Rs 1,40,000 equal to Rs 1,000. But for one lot, we multiply this by 100. Rs 1000 into 100 equal to Rs 1 lakh. So the gross payoff is Rs 1 lakh. But the trader paid Rs 5,30,000 as premium. Therefore, the net loss is Rs 1 lakh minus Rs 5,30,000 equal to minus Rs 4,30,000. The trader is still losing money, but the loss is now lower than the full premium. Example at Rs 1,45,000. Suppose gold futures expire at Rs 1,45,000. The intrinsic value per 10 grams is Rs 1,45,000 minus Rs 1,40,000 equal to Rs 5,000. For one lot, Rs 5,000 into 100 equal to Rs 5 lakh. The trader paid Rs 5,30,000 as premium. So the net result is Rs 5 lakh minus Rs 5,30,000 equal to Rs minus 30,000. Even though the option is in the money, the trader is still at a small loss because the premium has not been fully recovered.
Now I've understood that being in the money does not always mean profit.
Example at Rs 1,46,000. Now suppose gold futures expire at Rs 1,46,000. The intrinsic value of per 10 grams is Rs 1,46,000 minus Rs 1,40,000 equal to Rs 6,000. For one lot, the gross profit is Rs 6,000 into 100 equal to Rs 6 lakhs. After subtracting the premium of Rs 5,30,000, the net profit is Rs 6 lakhs minus Rs 5,30,000 equal to Rs 70,000. So at Rs 1,46,000, the trader makes a profit of Rs 70,000 per lot. Example at Rs 1,50,000. If gold futures expire at Rs 1,50,000, the call option is deep in the money. The intrinsic value per 10 grams is Rs 1,50,000 minus Rs 1,40,000 equal to Rs 10,000. For one lot, Rs 10,000 into 100 equal to Rs 10 lakh gross profit. After subtracting the premium, Rs 10 lakh minus Rs 5,30,000 equal to Rs 4,70,000. So the trader makes a net profit of Rs 4,70,000 per lot. Shape of the payoff chart. Let's see how the shape of the payoff chart helps us understand the price movement. As we can see, the payoff chart for a long call option has limited loss and unlimited upside.
Why is the line flat below the strike price?
Below the strike price of Rs 1,40,000, the line is flat because the maximum loss is fixed at the premium paid. That maximum loss is Rs 5,30,000 per lot. Above Rs 1,40,000, the option starts gaining intrinsic value. But the trader becomes profitable only above the break-even price of Rs 1,45,300 per 10 grams. After that point, every Rs 1,000 increase in the gold futures price adds Rs 1,000 into 100 equal to Rs 1 lakh to the gross payoff per lot. So every Rs 1,000 move above the strike price changes the one lot payoff by Rs 1 lakh.
So once I'm above the break-even price, every increase in gold prices increases my profit.
Exactly. Important MCX note. On MCX, commodity options are options on futures. So at expiry, an in-the-money call option will automatically get exercised and may devolve into long futures of the underlying futures contract. For the purpose of this payoff chart, we are focusing on the payoff of a long call option at expiry. However, in actual trading, traders must also consider brokerage, taxes, margin requirements, devolvement risk, liquidity, and contract specifications. Closing summary. To summarize, a gold call option gives the buyer bullish exposure with limited downside. In this example, the trader buys a Rs 1,40,000 strike gold call option at a premium of Rs 5,300 per 10 grams. Because the lot size is 1 kg, the actual premium paid for one lot is Rs 5,30,000. The maximum loss is limited to Rs 5,30,000 per lot. The break-even price is Rs 1,45,300 per 10 grams. Above Rs 1,45,300, the trader starts making profit. And for every Rs 1,000 increase in gold futures above the strike, the payoff changes by Rs 1 lakh per lot. This is how a long call option payoff works in MCX gold options.
I now understand how payoff, maximum loss, break-even price, and profit are calculated for a gold call option.